Imagine a company losing over 90% of its value, branded as Amazon.bomb, and widely expected to vanish. Now, picture that same company compounding shareholder wealth at nearly 37% a year for the next 2 decades. This is Amazon's story from 2001 to 2002. Wall Street wrote it off as finished. Long-term investors rewrote history. At the depths of the dot-com collapse, Amazon's bonds teetered. Its stock price cratered. Skeptics declared the business model broken. An online bookstore with no profits, soon to be crushed by retail giants. Yet, from these ashes emerged one of the greatest corporate comebacks ever recorded. In early 2001, financial analysts issued dire warnings. Amazon's liquidity was labeled tenuous, and a creditor squeeze seemed inevitable. The company faced over $2 billion in debt, negative tangible equity, and relentless cash burn. Media outlets amplified these risks. Upward financial leverage, depleted equity, rising dilution, stretched payables. By their math, Amazon was doomed. But what the market missed was Amazon's transformation in unit economics. First, Amazon enabled third-party sellers, allowing others to list and ship goods on its platform. Instead of holding all inventory, Amazon earned high-margin fees. Within a few years, third-party units expanded sharply, improving gross margins, reducing capital requirements, and accelerating cash generation. Second, Amazon enforced brutal cost discipline. Underperforming warehouses were shuttered, fulfillment automated, marketing costs slashed from around 13% of sales to the low single digits, all while sales began to re-accelerate. Operating expenses, as a percentage of revenue, shrank across the board. The result was operating leverage and, for the first time, positive profits and free cash flow. Third, Amazon made timely financing moves. Just before markets seized, it raised large convertible debt, then refinanced costlier notes in 2001 and 2002. Cash reserves hovered near $1 billion, debt levels fell, and Amazon bought valuable time to let these new economics play out. Look at the financial arc from 2000 to 2004. Revenue climbed from $2.8 to $6.9 billion. Operating losses of minus $862 million turned into $440 million in operating income. A net loss of over $1.4 billion flipped to nearly $600 million in profit. Free cash flow, negative in 2000, turned positive by 2002 and stayed positive. Inventory turn rates improved from 8 times to the mid-teens, third-party units rose, and marketing efficiency exploded as the brand grew self-propelling. Those lean survival years planted seeds for Amazon's next engines of growth. Logistics scale laid the foundation for Prime in 2005, a paid membership that drove purchase frequency and customer loyalty. Internal retail tools morphed into AWS, launching public cloud services like S3 and EC2 in 2006. These became high-margin growth platforms the market grossly underestimated for years. From a $6 trough in late 2001, Amazon delivered nearly 37% annual returns over 20 years, enduring multiple 30 to 60% drawdowns. The S&P 500 returned around 9%, Nasdaq 100 about 13%. The lesson? Staying invested in winners, not timing them, was the edge. Wall Street missed more than a turnaround. They missed a framework. Here's the investor playbook. Model cash, not headlines. Free cash flow and conversion cycles matter far more than GAAP net income. Respect shifts in unit economics. The third-party marketplace quietly rewired margins and capital efficiency. Identify option value early. Prime and AWS were barely modeled at birth, but changed the game. Survival extends the runway. Liquidity moves in 2000 to 2002 bought precious time. Finally, practice time arbitrage. Ignore 3-month narratives, but underwrite 3 to 10-year flywheels. Even Amazon's ascent was marked by brutal volatility. Minus 40% in 2004, minus 60% in 2008, minus 25% in 2014, minus 35% in 2018, and minus 50% in 2022. The ride was never smooth, but the lesson is clear. Stomach volatility, as long as the business flywheels and unit economics stay intact. In 2002, the consensus said Amazon was dead money. The data revealed discipline, reinvention, and optionality. Those who followed the numbers and waited won big. Which company today wears the Amazon.bomb label just before its inflection? The answer is out there. Listen to the data. Invest with patience.